external wars have a direct effect on your money, and also they are affecting your country big time. You might argue your country is not taking part in any war. That is a fair argument. But then again, what you don't know is that even those external wars have a huge effect each and every day on your money and your country. In fact, the food you are eating is affected directly by an external war. How you are moving is affected directly by external war. That is why in this video, I want to break down for you complex global affairs and economics issues for you to be able to understand in a very simple way how external wars are affecting you directly. You are all much welcomed to my channel. My name is Afagzad Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos around money and investing each and every day. If you love this kind of content, down there is a button called subscribe. Kindly click the button to subscribe to this channel for you not to miss any of my future videos. And while you still at it, drop a like on this video. Thank you for subscribing and dropping your likes on this video. Having said that, I'm currently domiciled in Kenya, Nairobi specifically, and I'm going to use Kenya as a proxy or an example as to how these external wars are directly affecting even countries which are not taking part in external wars. And by the way, these effects on Kenya are also applicable in almost all the countries out there. So regardless you're in which country, know these effects are also resonating with your economy. Having said that, the very first huge impact is high cost of fuel. What do I mean? We can use an example of the ongoing war in the Middle East. A country like Kenya imports heavily when it comes to fuel and petroleum products. So, a war like, for example, going on in the Middle East, those are Gulf nations, which are the major producers. And when there is uncertainty with regards to supply of fuel globally, and a country like Kenya is importing all its petroleum products, higher fuel prices are bound to hit the economy. And with higher fuel prices, everybody is affected. Transport costs, whether it is for private means or even public means, transport costs goes up and up. And of course, the net effect of that is that businesses are going to pass these costs to consumers. That is the first way in which external wars can affect your country and directly impact your pocket. And then the second way external wars affect you directly is because one of the effects of external wars is that food prices go high. Why do food prices go high? You see, before food reaches your table, there is inputs into production which go into producing that food, okay? And among the inputs in production are things like, for example, fertilizer and other things. So look at, for example, the scenario where the global supply chain system is disrupted. Case in point, the Middle East, or even that time when there was ongoing war. I mean, it's still actually ongoing, Russia, Ukraine. Some of these countries in that stretch around Asia and also Russia, Ukraine area, some of these countries are among the major suppliers of fertilizer globally. So if the fertilizer movement from those areas is affected, what is going to happen is that such an input like fertilizer is going to see fertilizer cost go up, because it's going to mean those exporters are going to incur high amounts to be able to continue getting fertilizer to countries which are importing fertilizer for their local use. And a country like Kenya is one of them. And therefore, if the inputs into production, basically the cost farmers are incurring to be able to produce food goes up, the net effect of that is that also the cost of the produce, which is food, is going to increase. Basically, the farmers are also going to transfer the costs to the consumers. And this is going to affect the prices of food. That's one way. The second way is, in case there is very dire cutout in supply chain of key inputs into production of food, is going to mean that also in that particular season, the amount of produce is going to be less compared to what was anticipated. And that is bound to cause a big problem in the economy. Because look at a scenario where the demand is fixed, okay? Or even better off, or even worse off, the demand for food is increasing because each and every day, people are getting born at a faster rate in a continent like Africa and also Kenya. So, if the demand is the same or slightly increased, and yet the anticipated supply of food has reduced compared to even how it was last year, the net effect of that is that there's going to be less supply of food in the country. And if there's less supply of food in the country, it's going to mean people are going to be demanding the same amount of food which they were demanding last year, and supply is less. In economics, that triggers something called demand pressure, whereby the demand is exceeding the limited supply. And in this context, the supply is affected by the external wars because the input into farming were affected. The net effect of that is something which is called demand pull inflation. Basically put, when you look at the forces of demand and supply in economics, that is going to force the price of the products to go up because demand is overwhelming to the supply. Do you understand? That is a way where external wars is directly hitting your plate because the food prices are going high. And talking about that, the third effect of these external wars is inflation in the economy. You see, inflation is a reflection of the average bucket of commodities or even inputs which keep the economy flowing. If the prices increase, it's going to mean there is inflation in the economy. And so, if there's an ongoing external war, think about it. The inputs into agricultural production, the cost goes high. Cost of fuel goes high. At the end of the day, the average cost which people are spending to maybe get food or even to take part in their daily activities, the ultimate average cost is going to go high, in effect triggering something called inflation, whereby prices of items are increasing. And that is quite a bad situation in an economy because if inflation is on the runaway, multiple things are bound to happen. First of all, people are going to suffer because they need more money to be able to cater for their daily consumption, for their daily movements, you name it. But unfortunate reality is that your salaries or your incomes are not really increasing rapidly based on how the costs of all these different things, for example, cost of fuel is going up, cost of maybe things like fertilizer and food is going up. Your salary is not increasing to compensate for that. And that is what in economics is basically called your purchasing power is bound to reduce. Case in point, if you are spending 1,000 Kenya shillings, okay, maybe to buy 5 items, as a result of the effect of external war, more so if your country is importing most of the things, is that you might end up even spending the same 1,000 Kenya shillings or about $10 to only acquire 2 things or even 3 things instead of 5 things you used to acquire. And also, on the government's end, the government will be forced to implement some measures, more so if inflation seems to be running away. Among the measures which the central bank in a country, like for example, the Central Bank of Kenya might end up implementing is something called contractionary monetary measure through increasing interest rates. If inflation is looking like it's running away, the central bank has the responsibility of managing the flow of money in the economy. So it's going to implement increase in interest rates so as to be able to tame inflation in an economy. And that is going to use something called contractionary monetary for it to implement this policy. Of course, at the central bank level, they implement monetary policies, and then nationally, the government typically implements something called fiscal policies through taxes and expenditure. But in this context, it's the central bank which is going to increase the rate. And that is something also quite disturbing because if the central bank increases its bank rate, there is also a ripple effect beyond just trying to manage the inflation, in that in case you have borrowed money, in case you have mortgage, you are paying mortgage, chances are your monthly payments are going to increase. And that is so because typically bank loans and also mortgages use something called floating interest rate or variable interest rate. Simply put, the rates which you're supposed to be paying, the principal and the interest component is going to vary based on what the bank rate is, based on the interest rates. So if the central bank is increasing its bank rate, that is also going to pass to you by the banks. It is a cost to the consumer ultimately. In case you are having a loan or you are having mortgage, you're going to see your repayments increase drastically because you'll be required to pay a higher amount on a monthly basis because of the monetary policy implemented by the central bank to contract some aspects in the economy. Okay? That is the third way which was externally affect you directly as a person and affect a country through inflation having the ripple effect I've described to you. And then the fourth way which an external war can affect your country is that with all these dynamics I've spoken about, if your country is doing heavy importation, relying on those external economies to get inputs into their production, there is, for example, inflation kicking in, ultimately the currency of your country is going to become weak. In this context, for example, all those factors holding, the Kenya shilling currency is going to become weak. And that is so because, remember, the currency of international trade is the US dollar, okay? So importers are going to require more dollars, right? And if they are requiring more dollars, remember also behind the scenes, investors are going to be moving their monies to safer currencies. That is going to cause the shilling to depreciate and imported products become more expensive because importers are requiring all the payments to be made in US dollars. So if there is no bump up in US dollars in the economy, that is going to cause the Kenya shilling to depreciate. And that in effect is going to mean Kenya is going to be paying more for products which is getting into the country. And be rest assured that cost is ultimately going to be passed to consumers for everything, right from foodstuff, even tools they are using, ultimately to anything, any cost they are incurring. You're going to see in the economy cost of almost everything going up. And then the other effect of external war, assuming all these things are happening in an economy, is something called lower foreign direct investment. You see, I told you, as a country, we're going to be relying, and that's of course international trade, on dollars to be able to pay for movement of goods internationally, purchases, you name it. And when the wars are happening out there, global funds become more cautious, okay? Investment projects might be delayed, okay? Even remittances being done by Kenyans and other people outside there into the country will shrink. And remember, as a country, yes, we have the dollar reserves, a little reserves with the central bank, but then again, the best way which we get our hands to the dollars are, for example, through international trade and also foreign direct investment, okay? So if there is a dip in all this, the net effect in the economy is gonna be beyond this hitting directly your plate, affecting how you are moving, affecting everything you are purchasing. Also, jobs are going to shrink. Because think about it, if business is slowing down, right? If global funds are becoming more cautious, it's going to mean that jobs are going to be affected. Whether it is jobs which are relying on the supply and demand of the different items, or even which are relying on ongoing projects, those are also going to be affected. And that is another way which you as an individual, you're going to see your money affected directly. People might lose jobs, or even they might see slowdown, thus affecting their ability to earn. And then the other way, external wars will affect your country and also affect you directly as an individual, is that there's going to be stock market volatility. Basically, the stock market is going to be more volatile. And that's so because when there is this external wars happening, investors also do panic. And investors panicking is going to make them increase the volumes of trade in a stock market and also other financial markets out there are bound to be affected. And this is going to make most sectors in the stock market to be affected. Some sectors might outperform others. But then again, the interesting thing with the stock market is that this is not a bad thing because the stock market thrives on volatility. Therefore, long-term investors might find good reasons to buy because they might end up buying the dip because of broader market effects. That is another way which external wars can directly affect your economy. And in case you are an investor, you have shares or stocks of companies in your country, you're going to experience the volatility. Share prices are going to be fluctuating up and down because of increased volumes in the stock market. And then another big way which external wars affect countries, and in this context, a country like Kenya is affected big time, is effect on tourism. Okay? Tourism is going to be impacted because global travel is going to be affected. Airlines are going to be impacted in terms of cost. They'll have to reduce their costs. Okay? Occupancy in hotels is going to drop. And the net effect of this is that in the tourism and travel sector, there's bound to be decline earnings. And for a country like Kenya, this is a very big problem. And I'm saying so because Kenya's GDP is contributed to by about 9% from travel and tourism only. Now imagine a situation where a good chunk of this earning is shrinked huge time. It's going to mean that as a country, we'll have a very huge dent in our ability to rake in revenues. And if we are affected by our ability to rake in revenues, remember, our budget is going to have a dent for both this particular implementation year and even for the subsequent year, because the revenues which are going to be collected are going to be less compared to the estimated revenue. And that is going to have a ripple effect. Decline in revenue, lost jobs, because also the truth is that the tourism sector, a good number of employees there rely on wages. They get paid when tourists travel into the country. Things like, for example, safaris, okay? Things like, for example, tour guides, you name it, are paid based on available work. So a chunk of these jobs are also going to be affected in the tourism industry and culminate also to the country losing bit of its GDP. And then the other effect of external war to a country is that based on all these factors, the sitting government spending and priorities will have to change. Because remember, the government is going to be continuing to be strained with regards to public finances. Okay? Also, in case the country is either directly or indirectly involved in the war, the defense budget might shoot up. Okay? And this might mean that the country will have to rearrange some of its affairs. They have to adjust the budgets during periods of global uncertainty to try and accommodate all these scenarios. Not to say the governments are going to handle all these to ensure the citizens are cushioned. Part of the government handling is also distributing the pressure on citizens. Because remember, the government is strained financially. It might need more money which is not coming into the country. Okay? It might have to adjust the budget in case it's directly involved in the war or not. If it is, adjust its defense budget extremely high. If not, adjust the defense budget just slightly in readiness for anything. Okay? And beyond that, development projects are going to stall. So, this is going to have a very big effect on the government. And remember, the government is also going to transfer some of these dynamics to its citizens to be able to try and see how to manage the pressures which are hitting the country. Having said that, the last effect, which is, I think, the only positive or the second positive on this list after the stock market, is that opportunities are bound to emerge. Even in those tough situations, opportunities are bound to emerge in a way that they are trying to mitigate or address the tough situation. And in the context of external wars affecting a country, some of the opportunities are going to be commodity exporters might benefit, okay, because of the growing demand and the disruption of supply chains, okay? Local manufacturing can grow to try and fill the gap which the global manufacturing and supply is being impacted on, okay? And then investors are bound to enjoy discounted assets. Remember, there is pressure in the economy. People need money. Even some sectors might see prices go down. For example, real estate and other sectors, because people need money and access to the money has been affected big time. Okay. Also, businesses locally will replace the impacted or disrupted imports. And generally in the economy, there's bound to be heightened innovation because when things are tough, also people in the country think about solutions. So there's bound to be heightened innovation, which hopefully even will be able to address some of the shortcomings or impacts of the external wars to a country and even leave the test of time beyond that for it to ensure that the country is advancing innovation-wise, to be able to strengthen its supply chain and its readiness to deal with the effects of external dynamics. Guys, those are some of the ways how external wars can affect a country and also affect you directly as a consumer. So don't assume that, for example, there is ongoing war in the Gulf nations, Iran, America, Israel war, or even ongoing war in Russia, and assume this war is not affecting you. Unfortunately, it is affecting you directly, regardless you are in which country globally, more so if your country is relying on foreign direct investments and also relying heavily on imports. I hope you've gotten a thing or two from this video. Which of those points have been enticing to you? Have I assisted you expand your mind when it comes to the effects of war to an individual and the country? Comment down below in the comment section for me to know how this video has been beneficial to you. Cheers, guys, and I look forward to share with you other amazing videos next time. Bye-bye and take care.